Saturday, February 28th, 2026. Iran's supreme leader is dead, eliminated in a daylight precision strike under Operation Epic Fury, confirmed by the Pentagon, confirmed by Israeli sources. The man who held final authority over Iran's nuclear program, its Revolutionary Guard, its proxy network, and the Strait of Hormuz, gone. Iran has responded. Ballistic missiles and drones are in the air over U.S. military bases across the Gulf. Dubai International Airport, the world's single busiest aviation hub, has been struck and shut indefinitely. Emirates suspended. Qatar Airways suspended. Iranian Naval Command has declared the Strait of Hormuz closed to all transit. The 21-mile-wide chokepoint that carries 20% of the world's daily oil supply is now a declared war zone. Tankers are already diverting, and that is only one war. On Friday, Pakistan's defense minister declared, in his exact words, open war with Afghanistan. Pakistani Air Force strikes hit Kabul, Kandahar, Paktia, and Jalalabad simultaneously. Afghanistan struck back with drone attacks and ground operations, claiming 19 Pakistani army posts destroyed, 2 declared active wars, burning simultaneously across the entire arc from the Persian Gulf to the Hindu Kush, on a Saturday morning when every Western financial market is completely frozen. COMEX is dark, the LBMA is dark, every traditional futures exchange is inaccessible until Monday. Here's the number that stopped me cold this morning. Physical silver buyback price in Shenzhen's Shuibei district, the largest concentration of physical precious metals dealers in all of Asia, is $120 per ounce. The paper market closed Friday at $93.66. That is a $27 gap, nearly 30%, and the dealers at $120 are refusing to sell. Commercial operators, businesses whose survival depends on converting physical inventory to cash, have looked at the supply chain behind them and the war in front of them and decided that $120 per ounce is still cheap for what comes next. The paper market has 34 hours of catching up to do. The world it wakes up to on Monday morning is not the world that closed on Friday. That divergence between paper and physical is not a pricing error, it is a structural confession, and the paper market has been locked behind a gate while the physical market has already moved on. Standard obligation, nothing in this video is financial advice. I track physical market data, geopolitical risk, and precious metals mechanics, and I'm telling you what that data shows right now. What you do with it is your decision. One question, drop it in the comments immediately. Are you holding physical metal in your possession this weekend? Or are you sitting in a paper ETF, a futures position, or a brokerage account that does not open for another 34 hours, physical or paper? Tell me now. When a geopolitical shock breaks on a Tuesday, capital responds in real time. Investors can log in, adjust positions, rotate into safe haven assets. The market is imperfect, but it is accessible. This weekend, that access does not exist for a single Western paper position in precious metals. COMEX dark. LBMA dark. Every derivatives exchange touching gold or silver is inaccessible until Sunday night's Asian session. The U.S. market opens Monday morning. Every ETF share is locked. Every futures contract is locked. Every mining stock is locked. The one exception, tokenized gold, blockchain-based instruments representing physical gold, trading 24 hours a day, 7 days a week, through every exchange shutdown, every weekend, every black swan. That market is currently printing $5,294 per ounce. Gold's Friday close was $5,278. The tokenized market has already repriced 216 on higher while COMEX sits dark, and that number is visible to every institutional portfolio manager on the planet. They have had 34 hours to prepare exactly one trade, their Monday open buy order. The demand building behind that closed gate is not a trickle, it is a dam. 3 real-world price signals, not historical analogies, not models. 3 things confirmed right now. Signal 1, tokenized gold at $5,294. This is not thin liquidity speculation. Tokenized gold is a blockchain representation of physical gold, unhaltable by exchanges, ungovernable by market closures. It is currently the only functioning price discovery mechanism in the entire precious metals complex, and it is printing 216s above Friday's official close. Because global participants spent the weekend processing bombs over Tehran, an active strait closure, and a Federal Reserve that has no credible response to supply-driven inflation in a war economy. Signal 2, Shenzhen physical silver buyback at $120. The gap versus COMEX Friday close of 93.66 is 27 and 29%. 2 markets, 2 realities. One requires actual ounces to change hands. That is the honest market. It is at $120. Signal 3, dealers refusing to sell at $120. This is the one that makes every other data point secondary. At prices, their entire cost structure, suppliers, employees, rent, carry cost, has never been calibrated for, the professional operators in Shenzhen are holding inventory. These are not ideological stackers. These are commercial businesses that understand margin. They have looked at the supply chain, the war, and the direction of sovereign and industrial demand and reached one conclusion. $120 is underpriced. Their refusal to sell at an extraordinary profit is louder than any analyst note published this weekend. The paper price at $93.66 is the outlier. Everything physically close to actual metal has already moved past it. U.S. and Israeli forces have executed coordinated precision strikes on Iranian military infrastructure, defense ministry sites, and missile development locations. Israel declared a full national state of emergency. U.S. embassies across the Gulf are in complete lockdown, all personnel ordered indoors. The IAEA previously filed a report documenting that Iran relocated highly enriched uranium at bomb-grade concentration into underground tunnel complexes, and stated it had lost full visibility on 60% of Iran's enriched uranium reserves. When 60% of an adversary's weapons-grade material becomes untrackable, the decision calculus shifts. Waiting becomes more dangerous than acting. J.D. Vance characterized the operation as fast and limited in scope. The United States made the same characterization entering Afghanistan, the same entering Iraq. Russia made it at the Ukrainian border in 2022. Wars have their own escalation logic that the architects of opening strikes do not control. What determines where metals go is not intent. It is geography. The Strait of Hormuz is 21 miles wide at its narrowest point. Through it flows 20% of the world's daily oil supply. Iran does not need to defeat a carrier strike group to inflict catastrophic economic damage on the global system. It needs only to make the passage credibly dangerous for commercial shipping insurance underwriters. The moment those underwriters price the strait at war-level risk, tanker operators reroute or anchor. Japan, South Korea, Taiwan, India, and China face supply disruption with no immediate alternative source. The inflationary impact does not phase in gradually. It arrives instantly across every supply chain segment that touches petroleum, shipping, manufacturing, agriculture, aviation, utilities. The 1973 Arab oil embargo, proportionally smaller than a Hormuz closure would represent today, pushed U.S. CPI to 12% and tripled the gold price in the aftermath. Today's pre-strike baseline, PPI at 3.6%, core PPI at 6.0%, both recorded in the final days before a single missile was fired. The Fed that navigated 1973 could theoretically raise rates. Today's Fed is servicing a $38.5 trillion national debt consuming over $1.2 trillion annually in interest, confirmed by current Treasury annualization data. Rate hikes into a supply-driven war inflation don't fight price increases. They trigger a debt service crisis. The Fed is not merely constrained, it is arithmetically trapped between two failures simultaneously. While every analyst is focused on Tehran, a second declared active war broke out on Friday, and almost no one in Western financial media has connected it to the precious metals story. Pakistan's defense minister declared open war with Afghanistan on February 27th. His exact words: Pakistani Air Force strikes hit Kabul, Kandahar, Paktia, and Jalalabad simultaneously. Afghanistan responded with drone attacks and ground operations against Pakistani military positions along the Durand Line, claiming 19 army posts destroyed and dozens of soldiers killed. The UN is deeply concerned. China is deeply concerned. Neither side is backing down. The variable that separates this conflict from every prior Pakistan-Afghanistan exchange, Pakistan is a declared nuclear weapons state with an estimated 100 to 170 warheads. A nuclear-armed state in declared open war with a neighboring government it accuses of sponsoring terrorism has no formal ceiling on its escalatory options. The words open war from a sitting nuclear-armed defense minister are a legal and strategic declaration. They are not rhetorical. Pakistan's Balochistan province borders Afghanistan directly and contains significant mineral extraction infrastructure embedded in global supply chains. Simultaneously, Pakistan is managing active terrorist attacks in Islamabad, Bajor, and Banu on top of an external military campaign, the conditions under which logistics fragility extends to refined metal export infrastructure connecting South Asian production to international commodity markets. Pakistan's institutional investors and high net worth population are not allocating into equities on Monday morning. Every historical war economy precedent says they are moving into hard assets: gold, physical silver, the metals that do not lose value when a government suspends peacetime priorities to fund a military campaign. We just added a second simultaneous declared war to the geopolitical board in a 24-hour window. The physical market in Shenzhen has already priced both. COMEX hasn't priced either. 3 scenarios, specific price targets, both wars confirmed, both unresolved, both escalating. All three scenarios carry a higher floor than they would with only one conflict on the board. Scenario 1 contained dual de-escalation. Iran and the coalition establish rapid understood boundaries. Pakistan and Afghanistan revert to the ceasefire pattern of October 2025. Neither conflict deepens. Gold consolidates between $5,200 and $5,500. Silver holds above $100 internationally. Shenzhen premium begins to compress as the immediate panic premium subsides. This is the most optimistic resolution available, and the floor of this optimistic scenario is gold and silver trading at all-time highs simultaneously. The minimum outcome of this weekend is already historically exceptional. Scenario 2. One conflict expands. Either Iran retaliates against U.S. and Israeli assets in force, creating active Strait of Hormuz threat, or the Pakistan-Afghanistan campaign deepens into a sustained operation, triggering internal Pakistani emergency. Oil spikes toward $150 from Hormuz risk premium alone. Inflation re-accelerates into an arithmetically trapped Fed. Gold moves decisively above $6,000. Silver breaks $150 internationally. The gold-to-silver ratio, currently at 56:1, begins its compression. Historically, ratios above 80.1 preceded the sharpest silver outperformance cycles ever recorded. At 56:1, the compression has already started. This scenario accelerates it. Scenario 3, convergent regional breakdown. Both conflicts escalate simultaneously. Iran activates Hezbollah, the Houthis, Iraqi militia. The Strait moves under active threat. Pakistan's nuclear posture enters the strategic conversation. Safe haven demand becomes multiplicative, not additive. Gold targets $8,000, $10,000. Silver targets $200 or higher. The 56.1 ratio collapses toward 20.1 as silver's pre-existing physical supply deficit collides with the largest simultaneous safe haven demand event in modern financial history. On Thursday, Scenario 1 was consensus. Tonight, Scenario 2 is the base case. Scenario 3 is no longer theoretical. Here is what Monday morning looks like mechanically, and I believe the scale of compressed demand is being systematically underestimated. Every institutional desk, every commodity trading desk, every systematic hedge fund running momentum strategies arrived Friday afternoon with pre-existing plans to add precious metals exposure. Then two wars broke out. Those plans have spent 34 hours converting from intention into certainty, validated in real time by a tokenized gold market printing $5,594. Forced inaction transforms a buying decision into an institutional imperative. This is not normal demand. Normal demand distributes itself across a trading session. Buyers enter at various prices throughout the day. This demand arrives simultaneously at the moment the gate opens. The price discovery that would have occurred over hours on a Tuesday is compressed into the first minutes of Monday. The opening move is not gradual, it is structural, before a single additional news event between now and then is factored in. Then, the mechanical cascade, every trader short silver at $93.66, positioned for a technical pullback against what they believed was an overextended rally, wakes up Monday with a position deeply underwater. Margin calls are not discretionary. The brokerage calculates the loss against available collateral and issues a liquidation order. Forced buying pushes price higher. Higher price triggers additional margin calls on other short positions. More forced buying. The cascade compounds with mechanical precision. Silver's market is structurally thin relative to the capital attempting to enter or exit it simultaneously. Silver does not drift higher in a short squeeze. It dislocates. That dislocation is already structurally loaded. The war coverage is obscuring the most important structural detail. The physical silver supply system was already fractured before the first missile was fired at Iran. China reclassified silver as a strategic material and restricted export authorizations to 44 approved companies, a decision that began choking physical silver flow out of the world's largest manufacturing economy months before this conflict. COMEX registered silver inventory, metal legally available for delivery against open futures contracts, has been posting consecutive monthly declines while open interest remained elevated. The divergence between shrinking deliverable supply and sustained paper claims outstanding is not a technical footnote. It is structural fragility dressed in the language of a normal market. Mexico supplies 24% of global silver mine output. Active civil conflict in key mining regions, including logistics disruptions at operations in Sonora and Sinaloa, is compressing extraction and delivery at the source. Shanghai physical premiums were already running 14% above international spot in the weeks leading into this weekend, not because of war, but because Chinese industrial demand from solar manufacturing, EV production, and semiconductor fabrication was already overwhelming available physical supply at prevailing paper prices. Basel III's net stable funding ratio now requires banks holding unallocated silver positions to carry an 85% stable funding charge, a regulatory structure that has been quietly unwinding the paper silver suppression mechanism that operated invisibly for decades. The $120 Shenzhen buyback price is not a war premium layered on a stable baseline. It is a war premium stacked on a pre-existing strategic supply squeeze, two independent forces, both pointing the same direction, both simultaneously pressuring a paper market that has acknowledged neither. Keith Neumeyer, CEO of First Majestic Silver, the world's largest primary silver producer, has publicly stated all-in sustaining costs are approaching 22 to 25 per ounce at the mine level. The gap between production economics and paper pricing was already structurally unsustainable before this morning. Central banks globally purchased 1,136 tons of gold in 2022, the highest annual figure since 1967, and remained above 1,000 tons through 2023 and 2024 as prices rose. Entities with unlimited fiat access chose to accumulate physical metal at escalating prices. That is not a speculative trade. It is a verdict on the purchasing power of fiat currency going forward. The 93.66 quoted on your brokerage screen is a mathematical abstraction. It is derived from futures contracts whose settlement does not require a single physical ounce to change hands, only a cash payment calculated against that paper price. That number is produced and enforced by an exchange that is currently closed. $120 in Shenzhen is cash passed across a counter for a physical ounce of silver, a human seller, a physical product, a real market clearing at a real price. Open right now. When those two numbers diverge by 30% and the market requiring physical delivery is the higher one, the direction of convergence is not ambiguous. Paper markets are supposed to represent physical reality accurately enough to be useful. When they fail at that task by 30%, price discovery moves to wherever actual metal is changing hands. 2 out of 3 active markets, the tokenized market and the Shenzhen physical market, have already repriced. Only the one behind a closed gate is still anchored to Friday. Monday is when all 3 are forced to speak to each other simultaneously. To everyone holding physical metal through this weekend, the thesis was correct. The gap between paper claims and physical reality that you prepared for is asserting itself, not through theory but through events. Those events are unfolding this Saturday morning. The metal is doing exactly what 5,000 years of monetary history said it would when paper systems are placed under this kind of simultaneous pressure. Subscribe to this channel right now. Enable all notifications. If Iran's retaliation escalates before Sunday night's Asian session open, I will be publishing an update before institutional desks can execute. That notification is the only early warning system reaching you before the gap occurs. Drop your Monday open prediction in the comments. Specific numbers for gold and silver. I am reading every comment. I will pin the most data-grounded analysis on this thread. The markets are closed. The physical market is not. $120 is the truth. Paper has 34 hours of catching up left.